then yes, you do
All right.
invest in
Let's see if we can get anybody back on.
application software, promising companies like Norm AI or Open Evidence, but you recognize that there's greater risk, but you're playing for greater upside. So I think as investors, you can get scared off easily by saying this is all a giant bubble. I think more importantly is to recognize there's a fundamental shift here. How can I do it safely? And the last thing I'd say is, I think investors are overlooking the risk of the disruption in their sort of back book, which is what happens to all sorts of businesses if autonomous vehicles come. What does that mean for auto insurance? What does some of this mean for lower value-added IT services? There's a whole range of businesses,
guys, so we had some technical challenges.
that are going to be
Back to the drawing board for the
advertising,
restream side.
media. So I think the key is to recognize this change is coming, and as investors, think about the various risks to your portfolio, not just is this one company overvalued. This is going to be profound, and as a firm, we're very focused on protecting our downside, but capturing the upside for our clients.
Yeah, we've heard a lot of those themes today and yesterday at this Goldman Sachs conference. John Gray, president of Blackstone, really appreciate your time today on this very important macro day as well.
Great to be with you, Leslie.
Thank you. Kelly, I'll send it back to you.
And noteworthy to hear him talk about some weakness in those parts of the consumer there. Leslie, thanks very much there. Thanks to Jonathan as well. Coming up, we'll hear from economist Claudia Sahm, who's also calling today's expected Fed decision an insurance cut. She'll explain why. And our coverage of the Fed decision continues next hour on Power Lunch, with our panel of experts here to explain their reactions to the decision and to look ahead to Chair Powell's press conference, which is always a big market mover. We're back with much more after this.
All right, so we had a bit of a technical difficulty on the stream side, and I had to stop streaming on multiple platforms, which means we lost most of the people in the stream, and I apologize to those who started. So I assume they will join us at least some point in the future. For now, we get to play with some of the toys. One of the first things we're going to play with here is the new angle of the shot. That's this shot here. You get to see me, I get to see you. And what we'll do is eventually bring the stream into the chat here on the left. Back to this cut, as you guys are used to. That's our mainstream. This is what we're going to be using for a lot of the stuff that we do in the future, but unfortunately with OBS down now, it killed a lot of the visual and the aesthetic that I wanted to have. So, live and learn. Meanwhile, I have a stream that is going on with links to the previous one all over the internet. So that ain't going to work for us. Let me do some work here while we're talking. Okay. Well, that certainly did not go as planned, did it, kids? Let me do a little bit of back-end work on my work, and then we'll jump into the actual topic of the show today. Show all. Interesting. Well, that was a fun little experience. All right, what's up, Danny? What's up, Matt? Sorry about the sound and the issues before. OBS got a little overwhelmed with the stream. We're waiting for the commercial break to come back on. This will be the most interesting FOMC meeting of the year. That being said, it will not be the most technical stream of the year. So we got a lot to improve in between now and the show. But that's why we test things. So it needs more NVIDIA. Yeah, no kidding. It does need more NVIDIA. Unfortunately, I'm running an Apple Silicon core, which is part of the problem. So you know how that goes. New computers, new technology, new things. But let's get this audio back on here on the show as we jump back on and see what we got.
We shouldn't cut because of inflation and because of the deficit. Those pressures are still too high. Obviously, others are more dovish. They think that we can and should. Explain where you come down on this.
Right. So I think it's appropriate for the Fed to be cutting again today. I was on board with the 2 cuts they've done this year. Frankly, the risk of a deterioration in the labor market We're not there now. We don't see signs of it right now, but we've seen a lot of slowing in job creation.
I would disagree with that.
The unemployment
Right out the
rate
gate.
has moved up for 3 consecutive months through September. That is exactly the kind of dynamic we do not want to see keep going and building. And so what the Fed is doing is they're taking out some insurance and trying to really buffer the labor market so that we don't end up in a recession. There is no reason.
Look at that
inflation
trend,
is elevated,
right?
but there is no reason to stand by and let a recession take hold.
So you think the labor market signals are becoming more worrisome?
They are.
I think when you look at the risks, the downside risks to employment are more substantial than the upside risk to inflation. They're both there. This is a tough call.
I would disagree with that. I would think the downside risk to employment is part of what will lead inflation forward. So obviously, if people can't spend because they don't have the money to buy things, inflation would, in theory, come down. So if unemployment rises to this point where that becomes a real issue, that's certainly going to be one of the things you see. But you're going to see a lot of talking heads today, like Herb. And what they're going to do is they're going to tell you straight up, hey, I absolutely 100% believe in this. But the reality that you have to face is that isn't always the case. They're saying what they need to say because they have a constituent base, people they need to appeal to. So what we're really going to look at here is not so much her opinion, everybody else's opinion. Those are just things you're going to hear. You want to take it in, you want to take it with a grain of salt, but you have to look at the macro situation that the decision makers, the 11 people on the FOMC who are making the decision, and that macro perspective as of today has been they're unsure, despite the fact that you're seeing some of the data loopholes. So the FOMC was supposed to get a lot of data before, and they're not getting a lot of the data now. Some of these are the jobs reports that you're seeing here. And you've seen some pretty alarming trends. Average hourly earnings, to me, is not indicative of strength. Unemployment rate is a problem. And look at the trend here. You're going up. 4.2, 4.3, 4.4. You're going to get back to healthy employment now. And what people don't understand with this is it isn't just a unilateral switch. What you're going to wind up doing is you're going to wind up pushing past what you think is healthy employment because it doesn't stop on a dime just because you cut rates.
Frame it as quantitative easing. It's more just like keeping enough liquidity in the system, kind of, the economy is always growing, and that kind of framing. So I don't have a firm view on, exactly when they should restart that, but absolutely paying attention to market functioning. That's also something that the Fed does not want to lose control of.
Do you have a level of rates that would be appropriate? We've talked about your rule, which is more about when recessions are on set, but how would you know where the right level of rates is?
Right. So the economy is always evolving. There is no one magical number. I will say that for each rate cut that the Fed goes through, it does raise the bar for the next cut, right? We are in an environment where inflation is elevated. Right. And so as the Fed is cutting, it's removing restriction. And it is, you have to keep going down that path. You have to be comfortable with the idea that, well, whatever extra inflation we have right now is going to kind of take care of itself.
Understood.
So
yeah, I don't know that I agree with that.
Cutting today, that doesn't mean just let it rip and just keep cutting.
What period of life have you ever been in where a business decision, a strategic one, was, you know what, it's going to take care of itself?
Cut Eve, Claudia Sahm, New Century Advisors. Our Fed coverage continues on Power Lunch. I'll join Brian Sullen for that right after this quick break.
So yeah, right out the gate, you're hearing somebody who's talking about jobs being, not that big of a deal. Job inflation numbers are down. Okay, I would say you don't know what you don't know because some of the job numbers that you've seen here are not updated. You're seeing private payrolls, which seems to express concern. We all know that OpenAI and AI in general are going to displace jobs. So for us to act unilaterally like there isn't a concern on the horizon is a bit strange for, frankly, what I think is going on here. Chris, can we get the master volume up a little bit? Yeah. How's that? Does that sound a little better? A little too loud? I can also go up a little higher if you want. It's hard to gauge it because I got multiple different audio meters here. So that should be significantly higher. Yeah, sound is back. All right, there you go. Sorry about that, guys. I'm trying to gauge. I went from one streaming platform to back to the ATEMs, to a more hardware-driven streaming platform. And in doing that, I kind of screwed everything up. I had to reset everything. Love the new side view. Yeah, you like the side of my headshot, Regil? It's this one here where I can look directly at you. I actually have the teleprompter up here, and I have down here. There we go. Get a little clearer here. I have a teleprompter down here, and I have the setup so I can look at myself and see you guys too. In theory, I was supposed to be able to chat to this while we did the cut here, but that's not going to happen. So it's all good. It's all good. Much better on your side. Thank you. All right, great. Well, I'm glad we got that going here. We're going to jump back into the audio here. So as we get into this meeting, you have to understand the overwhelming probability of a rate cut is real. It's high. CME, Chicago Mercantile Exchange, you've got Polymarket. Everybody's putting this at a near 100% probability. But what's really strange coming into this particular moment in time is that you've got a market which is reacting in an unusual way. The last 2 rate cuts had interest rates coming down, the 10-year in particular, leading to lower mortgage rates, slightly incrementally lower mortgage rates. And in this particular rate cut scenario, where we know there's effectively a 100% probability of a rate cut going into these, at least that's what the market believes, you're seeing the 10-year rise, actually pushing mortgage rates up. And we're not entirely sure why this is happening. Some people think because the market is believed to have the last rate cut it baked into it now, and everything else after this might be unknown. Some people are saying it's the holiday, season, the kind of the end of the year. Some people are saying it's Jerome Powell's last meeting. We don't know. But what I can tell you is the Treasury market is not responding the way that it has during the last 2 Fed meetings in this meeting. So, oh, look, a little bear. So cute. So I think what you're going to see is more interesting conversation. And as always with these things, the real value in this is going to be the commentary.
We are less now than 5 minutes away until
5 minutes,
the Federal
baby.
Reserve makes a call to likely lower interest rates or does not. The odds of a rate cut just under 90%. So the market is expecting a cut. So if we do not get one, stocks, they could fall. Or if Jerome Powell's comments about the future of rate cuts are not as optimistic or as bullish as some expect, stocks could also fall. It is arguably one of the most impactful potential meetings in a long time.
I think it is.
And ahead of it all, here's how the markets and your money are setting up. And as you can see, no big positions being taken either way. Dow's up a touch. S&P and NASDAQ are down a touch. Stocks mixed. Investors, traders really all in a holding pattern ahead of that Fed. Bond yields, they've actually moved a little bit up into this decision. 10-year rates a little bit down now, but we were just at 4.2% yesterday. And by the way, the average mortgage rate in America, 6.19%. According to Fannie Mae, because you may not care about what interest rates are, but you might care what borrowing costs are for either a house
that's a really
or
important note.
A car.
Really
Kelly
important.
Evans.
You absolutely do. Real quickly, there is a standout in the markets today. Don't lose this one.
Yeah, we don't
GE
care.
Vernova.
So, yeah, exactly what I told you earlier. The 10-year Treasury started to rise a little bit. You're seeing it come down a little bit today, I think, because the 100% probability is there. But this is by no means 100%. I think there's a chance that you're going to see some weird behavior here in the markets after the announcement of a rate cut. I do expect 25 basis point rate cut. Not having one now would be sending a shock in the system. But, oh, wow, Matt, no prediction today? Wow, no, that's your rate
Turbines.
cut?
All the money is in
Okay,
turbines. You want to power that through a pipeline.
I
through
would
a
like
natural gas
personally
power.
to
I
see
love that
no
everybody
rate cut right now and for them to wait a little bit longer. And I think you're more likely to see that now because of Jerome
sets you
Powell.
up not just for today's decision, but also the markets and meetings ahead in January, March, and April. Very pleased, as always, to be joined here in studio. David Kelly of J.P. Morgan Chase.
Stud David
Francis
Kelly.
Donald of RBC
Very
Capital
stoic,
Markets. Jim Karen of Morgan Stanley joining us remote. Jim, welcome as well. Francis, I'll start with you. Your expectations for today.
They're going to cut. But I got to tell you, today is not about this Fed decision for me. It's about what it continues to reflect about an incredibly complicated economy. We have very limited data visibility. We know that employment is softer. Inflation is rising. The economy is fragmented into that K-shape we all know about now. And let's not forget, we have a once in 100-year trade shock. How is the Fed going to explain all of this to us? And how are they going to set us up for 2026
Totally
in an
agree.
economy that is decreasingly interest rate sensitive and yet still has its firm eyes on what Powell or Powell's predecessor does next?
Would you consider David Kelly today to be what they would say is a hawkish cut, but with cautious language?
It's kind of like when parents give a kid, okay, you can have one more cookie, but this is the last cookie.
It never worked until the next one.
No, well, exactly. But I think there's going to be it's going to be a cut. We could get multiple dissents here, and I think they're
I
going
agree with
to
that.
really
Matt, agree too.
push it out and say, don't expect another near-term cut.
Jim, I don't want to look too far ahead of today because it does matter. 90% chance of a Fed rate cut today. Look at it.
And while he's answering that, I do agree with David Kelly. I tend to agree with him a lot, even though he's a very different personality than me. I do think that you're going to get a lot of dissents today, a lot of people with contradictory opinions. Because of those contradictory opinions, you're going to get less confidence in future rate cuts as a result. And I think that's why you saw the 10-year Treasury rise. I think the market knew it was a foregone conclusion, but I think the Treasury started to spike up a lot because they expect what's going to happen in January, March. And then you also have a new FOMC chair coming in May, and you have to kind of assume that Jerome Powell, towards the end of his tenure is going to be a little bit more outspoken about his concerns in the economy. So I think that there's going to be a lot coming on in the future that's going to make things a little bit more volatile as it comes to interest rates. And this is your last focused one.
Trade, you got the NASDAQ slightly down, the Dow slightly higher, the 10-year yield right around 4.16%. Let's go now to Steve Leisman on the Fed's decision
Here it is.
on interest rates.
Come on, Stevie, bring it home, baby.
The Federal Reserve reducing interest rates by an expected quarter point to a new range of 3.5 to 3.75. There were 3 dissents. The first time that's happened since September 2019. 2 were against the cut, including Chicago Fed President Austin Goolsbee, along with Kansas City Fed President Jeff Smith, his second dissent in a row. Also, another dissent for a 50 basis point cut from new Fed governor on loan from the administration, Stephen Miron. To recap, the vote was 9 for cutting a quarter, 2 against cutting, 1 for cutting 50 basis points. The Fed signaled a higher bar for the next cut, using language that it's used in the past to do so, saying that it will assess incoming data to determine the extent and timing of future rate moves. That language it used it last December to signal a pause. The rate outlook suggests consensus for just 1 more cut next year and 1 more in 2027. But as I'll get to when I talk about the dot plot, a lot of disagreement. Before the dot plot, though, I want to talk about some pretty big news when it comes to the balance sheet. The committee making a determination, it is now at what it calls an ample level of reserves. So it plans to initiate purchases of shorter-term treasuries on an ongoing basis. And then a separate document was specific, saying the Fed will begin buying $40 billion in bills starting December 12th. That's just a couple days from now. And I believe that's sooner than the market expected. And those purchases will go on for a little while at an elevated level because of seasonal demands for reserves that are out there before coming down again in April. That's what the document says. Outlook on the economy in the statement. GDP outlook was stronger next year in the Fed's own forecast, up a half a point to 2.4%. So pretty big move there in the outlook for GDP next year. The inflation outlook lower for next year by just a tick, down to 2.5%, just about hitting the target of 2.1 in 2027.
So nothing surprising.
The statement says the economy is expanding at a moderate pace. Job gains have slowed and unemployment has edged up. Just a note, the statement no longer says that the unemployment rate is low at the current rate. Inflation is seen as somewhat elevated. Economic uncertainty also elevated. Back to the Fed outlook and the dot plot real quickly here. Only 2 dissents, but 6 officials in total wanted no change in the funds rate according to the dot plot. So kind of a soft dissent in that regard, you can call it. 7 want no change at all for next year. 11 only want 1 cut next year. 1 person, and we can imagine who that is, Stephen Miron, just guessing here, wants rates down to 2.12% next year, or 150 basis points lower. And that is the statement and the outlook for rate cuts on the balance sheet. Mr. Sullivan.
Quickly, sir, you said buying bills maybe sooner than the market expected. This is not QE. I do not dare call it that. But is this like the son of QE, quantitative easing light?
It sounds like it. Yeah.
You know, Brian, people are going to take off on this, and I don't want to stop the craziness that'll happen in social media and on the interweb. The Fed will say this is maintenance of its balance sheet at a level of GDP of where it was.
A hedge.
Some people, however, will call it QE light. Some people will call it son of QE. I believe the Fed will say this is neither, that this is simply maintaining the balance sheet at what they call the ample level of reserves, and that will cause them or prompt them to begin buying $40 billion of bills. It looks like 3 years. They also may go out a little bit into the bond market as well, but they want to stick.
So let's be clear here, kids. I think it's important to note that as much as this is, an important thing to listen to, what I'll tell you is the most important piece of this is going to come in next, the commentary. As we always talk about on the show, the real value of what we get from these meetings is not the announcements. You can get the announcement anywhere on the internet. It's the commentary you're going to get from Jerome Powell afterward. And so much so in this particular meeting, you had effectively a guaranteed rate cut coming into it. No surprises there, which is actually a good thing. Number 2, you saw this weird Treasury kind of rise, so the market's kind of baking something in. But again, you've got an outgoing FOMC chairman who's probably going to be a little bit more vocal and a little bit less restrained given the tenure of his job and some of the public criticism about him. But you've also got him at a point now where they've removed something, and I don't know if he caught it or not, but one of the things that they do is they put out this statement. It is a document they put out where it's really repetitive, and they just redline a couple items out. One of the items they took out is that unemployment was low. So now unemployment under their net definition is no longer low. There's going to be a lot of focus on that in the commentary because, again, the Fed has a dual mandate. It's this price stability, and, of course, it is unemployment. And if they're concerned that unemployment has now reached a normalized level, well, then inflation becomes the concern, and where is that in the grand scheme of things? In my mind, you're going to see a significant deceleration and a lot more, I guess, stress at the FOMC meetings moving forward.
Time under 4%. We've had a total of 8 sessions close under 4% so far in 2025. The dollar index, no surprise there. It's down about 1/3 cent. It was down about 1/4 cent before the statement was read. It's definitely toying with this 98 3/4 to 99 level. It seems to have lost its hunt for 100 recently, but that makes sense considering the Fed's easing. And finally, the next meeting, January. Many are talking about the January 28th meeting. For a while today, we had about a 30% probability of a 1/4 point ease. That's now moved to around 24%. It's been bouncing around a bit. If you look at the March 18th meeting, that's also hovering around a 25% probability of a 1/4 point cut. But basically, the real issue for 2026 is how much the market's going to pull out on the easing mentality as we continue to get data that certainly doesn't look like the labor market is dying a quick death. And in terms of inflation, not a lot's changed in the last 16 months. It's sticky, and it doesn't seem to be coming down closer to the Fed's target.
Rick, appreciate it, and we'll circle back in a moment. But let's get more from Mike Santoli. Mike, on what jumps out to you about the market's reaction here and what the Fed just told us.
Yeah, sort of net positive. I wouldn't say it's a real vociferous reaction. Obviously, it's during the press conference that we sometimes get more of the swings or the rethink or the unwind of the unwind. We know the drill on Fed days. But there has been a value over growth, cyclical stocks over defensive stocks, financials leading, especially banks. That has meant that the market has been kind of revving in this direction of anticipating a firmer economic performance in the early part of next year. We could be proven wrong on that, but the market seems pretty...
See, I don't like the market as an indicator here for this, and I'll tell you the reason why is because I think you have a situation where everybody's looking at what normally would have been, I guess, traditional trends, but you're seeing very untraditional responses from the market. It's clear that you have the tech stocks, the Mag 7, frankly, the top 10 stocks in the S&P kind of carrying the way. But yeah, of course, banks are going to make money in this zeitgeist. You got banks that are making more money because they're paying less on interest on your savings account and charging more for loans because you're not seeing meaningful drop in mortgage and loan rates. Plus, a lot of these loans are priced index plus margin spreads over on like the business side, for example. So banks are going to walk into more profitability. I think you're going to see a huge M&A window for banks in the months and days to come. But certainly this, and I'll go back to the screen here, is not, in my mind, a good idea. I don't think the fundamentals, and this is part of why you saw a little bit of Michael Burry's commentary about pulling out from Zion Asset Management. I don't know if the fundamentals are necessarily leading the market at this point as much as hype and I don't want to say FOMO, but we've said that on previous shows. The fear of missing out on a financial opportunity is driving the market more than real old school fundamentals. And I think that's something to be said for a sensationalized economy a little bit. But let's look at the market's reaction a little bit. I'm a big fan of Francis. I obviously like David Kelly a lot too.
Hasn't been broad-based across all age groups. It's been really focused on young individuals in the United States. So is this really a labor market that's quickly deteriorating? It doesn't look much like that much feared hockey shape movement to me. Meanwhile, inflation has been above target for 55 months. So if I was looking at the bulk of the data and I looked at that dot plot and I looked at the Fed's forecast today, I would be saying, oh, they must have decided to hold or hike in that type of environment. What I want to hear from Powell during this press conference is, how the heck did you convince this committee to end with a cut today?
David, did they convince it? We had 3 dissents.
Well, no, and it sounded like we could have had 6 dissents. 6 dissents.
They dissented on what they call the dot plots, which I hate that term. It's like the Fed's light bright, where they put in where they expect rates to be. 6 non-moves on that, 3 actual dissents. So 3 people, I'm sorry, I'm going to say this, 3 people chickened out.
Well,
they wouldn't go on the paper and say, I disagree.
Well, exactly.
Shots fired, brother.
You can see that from the language in some of the speeches that we saw after the last Fed meeting, which actually convinced markets they weren't going to cut today, because some of the, particularly the regional bank presidents, are really hesitant to cut, at least in what they say. But then when it comes to it, they give the kid another cookie. And actually, it's a slightly bigger cookie than expected, because they got this extra liquidity for the short end. But I do think this is, more dovish short term, but still pretty hawkish long term, because if Steve's reading of this is right,
well, let me paraphrase. Okay, look, you've got a market where, and she was spot on this, where if by all outward measures you should be raising the Fed funds rate to combat inflation, because employment is within normalized levels and it is not low anymore. So you should be trying to temper that back a little bit. So the fact of the matter is you're not seeing that behavior, and you've got an FOMC which appears to be very, very divided on how and why. And to David Kelly's point, one of the challenges you have is you don't want to be somebody who's voting outside of the context of the group. There's a lot of groupthink that goes here. So nobody wants to be a public dissenter. Mirren is brought in large part because of his ability and willingness to dissent, and because he believed that interest rates should be lower for longer. But lower Fed funds borrowing rates traditionally means higher inflation over time. And if we have had high inflation for a prolonged period of time, why are we keeping it higher is the fundamental question, particularly if jobs are no longer defined as low by the FOMC's own statement they made today. And you're going to see, again, a lot of prodding on that in the coming minutes.
On balance, this to me is a more dovish meeting.
Yeah,
now,
I agree.
Yes, it is true. And I would really say that this is ironic, right? And I think we have to see the irony in this. The Fed has basically raised the bar for the next rate cut, right? So we still think they're going to cut, but it's going to be a higher hurdle for them to do that. However, they did surprise the market on the dovish side by moving that balance sheet management from what many people thought was going to be early next year to actually what's going to happen starting, right now here in December. The Fed is basically telling us that they want to have pro-cyclical policy, I mean, they want to support the growth cycle. They're going to stand at the ready to cut interest rates if the labor market deteriorates further. And at the same time, they're worried about liquidity. They want to add liquidity back to markets, call that reserves, call it what you will. The point, though, is that we need to get over the year-end turn, right? So liquidity constraints might come in at the end of the year. And the Fed wants to avoid that type of a stress in the marketplace. So net, the fact that they're willing to start to inject this liquidity, worry about reserves, and that's a lot of what's going to maintain, I think, some of the bullish sentiment in the markets, which is what we're seeing reflected, is actually the net dovish component, even though they raised the bar for the next rate cut. So I think it's a bit ironic.
Well, also, Jim, back to you, because a lot of people are listening or watching at home going, all right, this is great. What do I do? Well, to Kelly's point, the NASDAQ ticked up, the XLK on pace for its 13th straight day of gains. That would, I think, tie for an all-time record, or at least going back the 8 years. Why did stocks move up if prospects for more rate cuts went down?
Yeah. So effectively, one of the big concerns that was in the marketplace was that the Fed would have very inflationary policy, that they would be dovish and that they would push these long end rates higher because whoever the next Fed chair is, could potentially cut rates a lot. What the Fed is telling us right now is that they're not willing to do that. So what that's doing is
and they should be telling us that. You have inflation that is uncharacteristically high. It has been uncharacteristically high for a prolonged period of time. And I want to be clear when I say this, you've got a situation where if you don't address this meaningfully, the house of cards does come down, which is why David Kelly keeps saying, oh, we're giving the kid the cookie, we're giving the kid the cookie. Well, what happens when you tell the kid they can't have the cookie anymore? They lose their mind. And as parents, we all know that more than most, right? My guy Steve Leisman talking again.
Yesterday about the balance sheet expectations, and it was for purchases to begin again in April. So this is quite a bit earlier, and for purchases to average just about 28 or 30 billion. So this is more than that. So on that front, for sure, I would also point out that when I'm looking at the immediate reaction of the market, It's a little bit more dovish in terms of that next rate cut. We had it more fully priced in for June before the statement came out, and now it's about a 57, 58% probability for April. That's going to bounce around. And all of that said, this entire discussion, I would point out, may go out the window next week when we get October and November employment numbers, as well as some inflation numbers, and we'll figure out if the Fed made the right call here and whether or not the forecast is worth either the paper that was used to print it or the digital space it's taking up on the web.
That's an excellent point. As always, Steve Leisman. Francis, the Fed has two mandates. I mean, people forget about that. We always talk about inflation because of what happened during COVID and prices spiked and inflation was 9%.
If you comment on jobs
but they
here,
also
bro.
have the jobs mandate, maximize employment. How do we read the jobs part of the picture vis-a-vis what the Fed may or may not do?
You mean the lack of
I've been thinking a lot
employment?
about this because I keep wondering to myself, how can you be cutting interest rates when inflation is this high and per our forecast going to be heading higher? In fact, it's really hard to see when that next cut is going to come through. I have to agree with David here. When is the window to do that?
Yeah.
Because by February, we see that inflation side moving higher. And yet, Brian, this is not interest rate driven inflation.
No.
This is tariff level inflation. This is inflation that is coming from a labor market that is shrinking, immigration, retirements that are coming through. And part of me wonders if this Federal Reserve is saying our interest rate policy is far less relevant to the inflation side of the picture than it is to the job side.
Okay, let me follow up with that. Do we ignore, I hate to say this, do we ignore inflation? If exogenous factors, tariffs, whatever, are contributing, labor costs during COVID,
that really
whatever,
his solution?
if they're
Ignore
contributing to inflation and there's nothing the Fed can realistically do about it, should they cut rates anymore at all?
Well,
why not raise
you should not.
rates?
That's
Here's
the point.
the rub here. The problem is if they don't actually
so
contain
frustrating.
inflation, it can spiral out of control. So you start with tariff level inflation, you start with some wage pressures that sort of create a floor underneath. If you don't respond to it properly, if you're too easy, then that can start to spiral. But there's another elephant in the room here, which is that we have phenomenal amounts of fiscal spending. And how funny it is to me that we spend so much time attributing monetary policy to inflation, and we forget that expansionary fiscal policy is also very inflationary. So the forces on inflation are wide-ranging and shouldn't just go to the Federal Reserve policy. So it's not a surprise to me that their bias is towards the labor side of the mandate.
Well, I think the other part that we're not talking about is just how high the equity market has been. I mean, this is the end of 3 booming years for the equity market. And I personally don't think the Fed ought to be cutting aggressively or at all right now, but it's not because of what they're going to do to inflation.
My guy, David Kelly.
I would have dissented and I would have voted the way I did with what I said.
That's right,
because
sir.
The
That's
problem
right.
is that they have caused asset bubbles over the years by keeping rates at an unrealistically low level. And I think the danger is they're just going to cause another asset bubble. And when these bubbles burst, they cause tremendous damage. So there's nothing wrong with a federal funds rate at 3.75% to 4%.
I think that's
okay.
environment.
The economy should be able to do.
The president would disagree because people want mortgage rates to go down to 5%.
Well, the mortgage rates, long-term mortgage rates are determined by the 10-year, not short-term rates. And if you scare people about inflation, or indeed if you cause a booming stock market, that actually will probably help keep those long rates higher. So I don't think. Anyway, why do we have a housing problem? It's not because mortgage rates are too high now. It's because the mortgage rates are way too low.
So what he's going on is if you have a booming stock market, even if you start cutting the Fed funds rate, you're going to push the 10-year up and mortgage rates aren't going to come down. So this whole weird narrative that you have the Fed funds rate equals lower mortgage rates that we've heard cycle and cycle again over the course of the last several months and frankly years has been so warped and just completely corrupted by this weird period of artificial interest rate deflation. And because of that, you've got this narrative and this focus solely on this in a way that we've never really experienced before as a community. Let's see what my guy has to say.
Argue with you. The market can only do so much. If the Fed starts pulling out securities from the marketplace, affecting supply and demand, it does make a difference. Now, to that end, the yield curve is steepened a couple of basis points. Now, I understand many out there saying, well, a couple of basis points, but it is significant how it's doing it. So a 2-year note right now is almost exactly 2 basis points lower than before the statement. The 10-year is exactly the same. Arguably, the yield's a little bit higher. We've touched 60 basis points in the 2-10 spread, and I think that is something to pay attention to. It doesn't surprise me that the shorter maturities are looking at this in a more dovish way than the long end, because the long end has not only to try to distinguish between what's going on with the economy and the Fed, but it also has to keep an eye on things like debt issuance and just total debt around the globe. We did postpone today's $22 billion 30-year bond auction because of the Fed meeting. We'll have that tomorrow. But I think it'll be very interesting to see how that demand goes. And then finally, Steve Leisman pointed to some of the percentages and probabilities in Fed fund futures. And I always put a word of caution that these things are just markets. They change moment to moment. But the next meeting that even is close to the possibility of an ease, anything over 50%, that would be the June 17th meeting at the moment. Back to you.
All right, Rick, we really appreciate it. And I think it's a good point to make that as this kind of settles in for the past 20 minutes, markets are looking a little bit more on the bond side like they were pre-decision, although equities are still near session highs. Let's talk more about that now with Jeff Kilberg. He's the founder and CEO of KKM Financial. What do you say, sir?
I have no idea who this guy is.
Well, Kelly, kind of a surprise. Everyone was looking for a cut in rates, more hawkish. And we actually got more. If you think about that, $40 billion they're going to start purchasing in just a couple of days. That's annualized $500 billion of new QE. So with a $6.5 trillion balance sheet, I think a lot of folks were surprised. That was the initial reaction.
I think we're done listening to that guy for right now, because I don't think anybody was surprised by. I mean, unless you guys heard something I didn't hear, I don't think anybody was surprised by that. So, little rule I live by: if you look like this guy, I don't trust you. And you know what that is? He's got the traditional buttoned-up banker look, the pinstripe shirt. I've never heard of you. It sounds like you're a salesman. That's all I'm saying. So you might have a value to spin this. That's what I'm going to say. And I know that sounds terribly critical, but you know what I mean? I've seen a lot of talking heads on CNBC that come on and you scratch your head and you go, why is this person here? And you realize they're selling themselves from a media perspective, and they're trying to appeal to their base, which in a lot of cases, and I'm presuming, and I'm a lot of assumptions here, I'm presuming this guy is somebody who manages somebody else's money, and that's probably why he's trying to keep a rosy, optimistic perspective here. Let's get back into it and hear what he has to say.
Something, and this $500 billion annualized, it's $40 billion a month, folks. But this $40 billion a month that's starting in a couple of days, that is really surprising. I think that's going to move equities a lot higher, because this is, I know we had one dissenter wanted 50 basis points. This is like a 35 basis point cut, because it's another tool in their toolbox that is getting the same outcome. And it's going to increase the balance sheet, which is crazy that they just slowed the balance sheet down from draining, and now they're kicking it off.
There's a lot to come in, and I'm totally sympathetic. I think you're right about the market taking it that way, no question. But they'll argue that this is it's wonky. It's financial system plumbing. It's that the bank reserves level is getting too low because we're in an ample reserves, not a scarce reserves regime. And we saw this in 2019 with the repo flare, but they don't want it to happen again. So it's more of like a management tool, right, of the financial system than it is a tool of monetary policy. Now, maybe those are two sides of the same coin, but it seems as though the real question is whether they intend to do anything beyond kind of keeping up with the level of GDP that they're kind of doing now with the balance sheet, doing something more meaningful, more expansionary.
I don't think so.
And I think there's going to be a lot more questions about that. What is their intent now with the balance sheet? Is this just a temporary fix to a repo problem, or is it something more?
It feels like they brought the first aid kit out, and we haven't seen the wound yet. So maybe this job situation is going to decrease or get worse. But right now, the economy is strong.
It's going to get worse.
Profits.
It's not strong.
Profits,
it's
Kelly.
not, dude.
It doubled expectations. Yeah. And I know there's been an old saying, profits are the mother milk of the stock market and the economy. Maybe we update that and say, profits are the creatine of the stock market and economy. But we are seeing such strength. This is very surprising.
I don't like you, dude.
Can I say something that's probably a little bit controversial?
Please do.
Okay, which is, you mentioned Jerome Powell. He's a human being, okay? His term is up in May.
That's right.
No matter, I would think, and I don't know Jerome Powell at all, okay? Steve Leisman does, so maybe he can comment on this if he pops back on, but I know he's got to go to the lockup. Jerome Powell's a human being. He wants to go out looking good, I assume, right? Does that factor into the thinking? You don't want to go out doing something that causes the stock market to go down or wobbles or whatever it might be. I think you want to go out, particularly when you're being attacked by the president every week. You want to go out kind of on top, and I don't think it's unfair. I know it's the Fed, but these are human beings whose heart pump blood. I think there's probably a feeling they want to feel good and go out like a hero, not a villain. Yes or no?
Not necessarily. Fed Chairman Powell, I think he's done a great job of deflecting all that. He's a strong human. He's always been fiduciary. He's doing what he thinks is right. So I don't think he's going to bend one way or the other to make his, riding off into the sunset look better. But he's doing this for a reason. And that's where I really want to unpack and get a better understanding. Why did they do more than the 25 basis point expectation?
I recant my sentiment about this young man. He seems to be fairly level-headed.
Maybe they
despite
did.
The sales pitch spin.
Maybe it's just a tool for, the banks have been having a hard time. Jeff, I don't know if you saw all-time highs, for the bank stocks.
I note sarcasm.
But Kelly, think about it. Every time they've cut rates with the S&P near a 2% or less high, when we're this close to an all-time high, the times they've cut it, it's been 20 times. Guess how many times a year later the market's been higher? 20 times, 100%.
And that's why we talked to Tom Lee, or a little bit earlier on, who said he said even if it's a hawkish cut, he would view that as kind of a bullish outcome or a bullish signal. So you have to imagine that this leaning more in the direction towards accommodation
seems dovish.
Even more.
So we got the VIX dropping, as Matt noted there. The fear gauge is going down. Seems to be a little more confidence in the market at the moment.
No, I think you have to really focus on this presser. We're going to see what's about to happen.
Yeah, presser's going to be a big tell.
Speaking of, let's take a very short break, folks. One small commercial break. Come back. It's the final.
So while he's doing that, let's go over the chart work a little bit here. Here's your VIX. It's pretty indicative of the fear coming down, which is pretty normal in my mind. Post, I think, successful result. If they had gone against the market, I think you would have seen this go the other way. Keep in mind, this is not a big delta, 16.5 versus 17.5. This has only gone down a tiny bit. So if you see this above 20, I would start to freak out a little bit. For right now, I think you're fairly healthy as far as long-term fear goes. If you go to year to date, you saw a spike up of fear here. This was back in April, and you've seen some smaller spikes here of fear, I would call it, in the market. So this guy back down to a healthy normal. But again, this is also cyclical. This goes up and it comes back down. So if it's on this way down, you're going to see some fear come back up, particularly as you're seeing changes in concerns and thoughts in the market as far as perception goes. Let's bring back our little chart here. So I do think that we're going to have an interesting press conference, and I think this is going to be well worth the wait. For those of you who do not typically watch the conference pieces, this is where really the magic happens. And let me cut back here to the main camera. So look for Jerome Powell to get pressed a lot on what this quantitative easing light really is supposed to be. Look for questions about the job statements or changes to the job statements that we've seen in the market from their press release coming out so far, suggesting that jobs are not, quote, low anymore. Look for commentary around the lack of data being a known quantity, but not a significant concern. They're not going to want to overstate that. And certainly look for increasing hesitance to be hawkish on future rate cuts. Expect them to want to slow down that narrative a little bit and talk a little bit about we'll wait and see and be data dependent once again. Strangely enough, even though they have light data now. So I expect this to be an interesting press conference. I expect him to get pressed a little bit, and I expect what he says to drive the probability of the next interest rate cut down dramatically. Right now, about 50% from Chicago Mercantile Exchange, I'll check Polymarket here in a little bit, is not hyper concerning to me post a rate cut announcement. You'll see the meaningful changes come up here in the press conference in moments, and those changes will be what really should tell you that you should expect over the course of the next month or so, actually about 45 days, until the next FOMC meeting. Let's get back to the program here and expect the press conference to start momentarily. Meanwhile, we can look at this beautiful deer. Aww. Matt, I imagine this is what you look like on the beach in Hawaii right now, just elegantly cruising along the ocean water. Yeah? Is that what you look like? And again, for those of you who joined us late, I apologize. We're on a different stream than the one I originally posted. I had some technical challenges. One of the things, if you're in the streaming space, streaming via a software can become challenging, and I tried doing that with for the first time with this actually playing, and because of that, I think it was just overburdening a lot of the GPU on the system. So this allowed us to get back to the hardware-focused drive. Here we go. Let's get into it.
You referenced, Kelly, the XLK Tech ETF. Why?
There's a couple of reasons. I mean, we also need to look at tick by tick what's been happening since the decision at 2, which was initially we saw this big positive reaction. As Brian mentioned, it pushes the tech ETF, the XLK, now to possibly a 13 consecutive day of gains and a winning streak. However, look at what's happening on the screen now. We're already seeing this pre-Powell positioning where those gains that we had are coming out of the market. So the tech XLK is down about 0.25%. The small caps we'll have to check out as well. Those surged to an all-time high. Silver was part of that trade. The Dow is up as much as a little more than 300 points. A few moments ago, Kilburg gets up 206. So you see the potential for this market to take this and run with it in a dovish direction, but it's going to be really important how Powell emphasizes whether the QE that they're doing is simply bill purchases to help maintain the plumbing of the system, or something more meaningful, along with everything else he's about to comment on.
I don't think he's going to give us a look underneath the hood to that extent, but you're absolutely right. That's what the market's going to decipher by the end of the week, and that's why I think the longer, bigger picture here is that Treasury yields, we got more than we actually bargained for today with that 25 base rate cut.
So to your
All right.
point about 20
He's not
times
a bad
out of
dude.
20 times, by my math, and I went to an engineering college.
It's pretty good.
That's 100%.
It is.
That stocks are going higher over the next year on this cut.
It's not going to be a straight line, Sully. It never is. But when you see the VIX in conjunction with that stat, when you see the VIX, the decay in the VIX, just remember 2 weeks ago when we were a little bit squishy about the actual Fed interest rate cut happening or not, we saw the VIX go up to 28, went back down to 15. When you see that vol get crushed like that, that's when you see people really feel good about equities on a 30-day lookout. And then, yes, that's that, Sully. 20 out of 20 times higher a year later.
But you're also ignoring that they probably shouldn't be that confident.
What kind of feeds to you the bullish narrative versus bringing some doubt into what they've just done?
I think I want him to really kind of give his understanding, will he be sitting on his hands in the next quarter? Because a lot of folks are thinking that we are going to see a rate cut, if not two. Goldman's in the camp that we could potentially get 2 rate cuts in Q1 of 2026. So I want to hear something as he kind of positions the ability to kind of hedge, which he always does a great job of, but that's what I'm really looking forward to getting an understanding. I don't care about the
There's the guy. Come on, baby.
Powell. Let's listen into the Fed.
JP in the house.
Good afternoon.
Good afternoon.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people.
Where have I heard that before?
Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by 0.25 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments.
Ooh.
Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter.
Based on what?
Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point.
All right.
With today's decision, we have lowered our policy rate 0.75 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning,
I want more
and
clarity
should
on
be
that.
used when economically sensible.
Yeah, I'm not sure that I buy that.
To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices.
Yeah.
We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Let's get into it. Who's it going to be? Who's first up?
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
He's setting it up
for on the outlook there. It seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it is it's partly that consumer spending has held up. It's been resilient, and it to another degree it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters, there is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive. And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
And then if that changes, you've got nothing? Is that what it is? I mean, that's a...
Thank you, Mr. Chairman, for taking our questions here.
Steve!
You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here? And have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have, if you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment and the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down, and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, you know, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the S&P.
Wait and see.
You have a whole lot of a big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more.
Yeah, but see, this narrative bothers me a great deal. I'm actually going to cut off Jerome Powell for it. If you increase productivity over time, right, of the individual, and you layer that on as AI, the natural logical progression of that is to increase productivity of AI and decrease your higher cost of capital in this case, which is not going to be deployment of AI. It's going to be deployment of humans.
Others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our two goals are a bit in tension, right? So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk.
Okay, but how is what you're doing addressing either of those
concerns? The difference is how do you weight those risks, and what does your forecast look like, and where do you, ultimately where do you think the bigger risk is, and you know, it's very unusual to have persistent tension between the two parts of the mandate, and when you do, this is what you see. And I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views. And you know, we come together and we reach you know, a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, you know, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these
He's
measures,
done everything but say we're going to wait and see. We're data dependent.
In the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're gonna look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. I mean, you talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions. And you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side.
Can you imagine being this dude for a minute? Just think this through. He's literally had the president say in open forums in front of the press that I wish I could fire his ass, and he's doing his best to be as diplomatic as he possibly can. But he's making this sound like it's gumdrops and lollipops behind the scenes.
That risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. It can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down? Or should we think of policy risks as genuinely two-sided from here?
He's not going to answer that question.
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year, but when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3, is not a big data set. But you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today
4.2, 4.3,
no longer
4.4.
describes the unemployment rate as remaining low.
That's right.
What gives you confidence it won't continue rising in 2026?
There it is.
Especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the, notwithstanding the 150 basis points in cuts prior to today.
Good question, brother.
I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would say point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both showed declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story that
at all.
This is that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs, and.
So yeah, I don't agree with that. Are we gonna just now exclude and put inflation in a set of circumstances where we're saying that inflation is only happening in this one sector now where tariffs are, because that ignores years of inflationary trending, that ignores that inflation is still running high, that ignores a lot of things. So you're just going to say, oh, we have this one thing we can focus on and blame that. I don't know if that's a smart move.
That this was a decision to make. It obviously wasn't unanimous, but overall that was the judgment that we made, and that's the action we took.
Just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest-on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th.
So QE light.
There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20–25 billion per month. So that's a small part. That's going on. It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
I have never heard that before.
Andrew.
Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
He's not going to answer that, dude.
It's not something I want to address here, Andrew. We're not legal commentators. It's before the courts, and we think we don't think that we help matters by trying to engage as a public discussant of that. I'll give you a mulligan, though.
No, thanks. I don't know if that means I get 3 questions, but
no, just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our 2 goals. And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, as you know, says that when that's the case, that we try to take a balanced approach to the 2 things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really. But it just tells you you've got to, and I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral. Because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say. And that's what we're doing now. It so happened that we've cut 3 times. That we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Edward. Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff inflation, it takes, there's the announcement of a tariff, and then there's, they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of the, it may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. And after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
There you go. No.
No mulligans for it. Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
That's right. Good question.
So we're looking at the real economy and focusing on that. And you've got when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very that's one part of it is inflation compensation break-evens, and they're at very comfortable levels. They're at levels consistent once you get out past the very short term now. Break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation as their #1 concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their #1 concern, inflation?
Yeah, great question. Fantastic question.
As you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs.
Then address it.
A lot of
then
that is
talk
not
to them.
the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23.
But that's still a problem, dude.
That's what's going on. And so the best thing we can do is restore inflation to its 2% goal, and our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and
but they're not.
And earning money, and we're going to need to have some years where real compensation is higher, it's positive, significantly positive. So nominal wages are higher than inflation.
Agreed.
For people to start feeling
How does that happen
about
with
affordability,
AI?
the affordability issue. And, so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages so that people are earning enough money and feeling economically healthy again.
Victoria. Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2% because inflation is relatively stable where it is?
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much. But it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation, and we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low 2s, right? So it's really tariffs that's causing most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry, about the labor market, because the labor market unemployment was very low. If you remember when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both, and I think we're doing the best we can for people. They also care about their jobs. They do care about affordability. And the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth. Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody. They have a survey. And there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing. and it will be corrected. I don't have the exact month in my head right now, but and that's just, again, I think forecasters generally understand that. So, and we think it's about 60,000 a month, so 40,000 jobs could be negative 20. And, that could be wrong by 10 or 20 in either direction. But in any case, but the thing is, that's job creation in a way, that's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance. And since job creation, job finding rates are extremely low, if there were big numbers of layoffs, you'd expect the continuing claims to go up, and you'd expect new claims to go up. But really haven't much. So it's a little bit curious. Longer term, though, the question is, what are we going to see here? And we don't know, but it's there's a
we don't know.
It may be that in past technology, really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen.
That's interesting.
What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Enda.
Thank you, Chair. Enda Curran, Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
the policy what? On
the committee?
Thank you.
Why is there such a division of views between the presidents and the board members?
It's not so stark as that. The views are more varied in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
He's not going to answer that, dude.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine.
Thank you, Chair Powell. Christine Romans, NBC News. Wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy, and what are the Fed's thoughts on whether that's a risk going forward?
Good question.
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So as how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think, the top third accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. You know, the best we can do is to have a, you know, price stability and a strong labor market. And what we saw, for example, what we saw at the end of the, you know, the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, you know, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have you know, full employment, maximum
I don't think people
employment.
feel that
And
way.
just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record.
He doesn't know, and it's not his prerogative.
Yeah, so the housing market faces some really significant challenges. And I don't know that, you know, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. You know, housing supply is low. Many people have very, very low rate mortgages from the pandemic period, and they kept refinancing and caught the really low. So it's made it expensive for them to move. And, you know, we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time, and so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be you know, a problem, and you know, really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address, you know, a secular housing shortage, a structural housing shortage.
There you go. Not his prerogative. Paraphrasing.
Chris. Thanks. Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are the inflation risks? It looks like inflation is cooling, in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, you know, we see higher inflation. As I mentioned, most of the inflation over target is from goods, and we estimate, we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? You know, that's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs will just keep doing that. So you'll see you see that. I think the other possibility is less likely, and that is just that you know, the labor market gets tight or the economy gets tight, and you see, you know, just traditional inflation. I don't see that as particularly likely. But so I think, you know, again, you know, all across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to make an assessment, and this is the assessment we made.
Hi, Chair Powell. Neil Irwin with Axios. So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had, you know, 5-6 years of 2% productivity growth. This is higher. You know, this is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes
AI?
people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having, social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what I'm. And it's I don't have time to think about bigger things. I hope many years ahead to worry about that, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time as chair. I haven't got anything new on that to tell you.
Go to Mark for the last question.
Chairman Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates, or yields to be more precise, have peaked, while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank?
I don't know. I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy. But we've moved back our policy back down to where it's not. It's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave. Sort of every large economy in the world, sort of every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
Wow. Wow. Okay, well, there you have it, everybody. Let's go over some basic recap here. I think it's important to talk a little bit about what we just heard and saw. So before I switch off of this particular setting, I want to share some feedback. So he said we were in the early days as it relates to AI. There's a natural tension, which we talked about a great deal, between wages and employment. And certainly I think that that's probably a true statement. Reserves, the quantitative easing light, seemed to be a bit of a response to what he expected to be tax season. There's a lot of narrative out there in the public, the general public, about how the Fed repo line is being used too heavily. I don't think that's true. I think what people don't understand is a Fed repo line is a good arbitrage point for most banks. They can borrow on it cheaper, deploy that capital, make some spread overnight, and take in those earnings for a relatively cheap cost. In doing so, from a liquidity perspective, is important. Now, as those banks borrow because they need liquidity to give to the clients, which ultimately give back to the government in the form of tax payments, that's really what he's suggesting the quantitative easing light is building up to. Let's look here on the main screen together. Between July 2024 and July 2025, average weekly wages did grow faster than inflation. You can kind of see here, wage growth did outpace inflation. However, I don't think that tells the entire story. We've got a great deal of time to make up, and we are approaching this asset-light economy because people haven't been able to buy homes. That is the largest source of wealth building for most Americans, the equity they build in their home over time. This is the chart on inflation. You can see that 2% is the target inflation. It used to be 2 to 3%, but they recently have reaffirmed that they wanted it to be 2%. So you got really a situation here where you've got from 2021 forward significantly higher inflation than that, 7%, 6.5%, 3.4%, 2.9%, and still 3%, given that rise to that persistent inflation. Inflation is persistent. It's not going down. They're concerned about that. And the jobs numbers, which were below 5%, now 4.5% lower. The unemployment is rising. Now, a certain amount of unemployment is healthy in the economy. You want to have some healthy transitory migration from job to job. And when you were below, call it 4%, I would say you didn't have that. But now when you're approaching about 4.5% from an unemployment standpoint, you have what is perceived to be healthy unemployment or close to it. You've got inflation that's slightly elevated. The question is, do you need more rate cuts at this point in time? Because rate cuts can be inflationary and push rates up. The other thing he talked about too is homes a little bit. You can see homes are starting to adjust in value here. 436,000 peak median home price in Q3 of 2022, I should say, creeping up to 442.6 and then down to 429. And we've seen this actually kind of drop down here to about 423,100. Not meaningful to most Americans, but what I will say is it does mean that you're starting to see a slight correction here. And I think I read a stat recently that about 53% of the country is showing some home price improvements. If you look at this from a one-year perspective, the number becomes a lot more visibly dramatic. And I'll keep in mind the narrow band here is not meaningful, 420 to 410 for most Americans. But you are starting to see some improvement as been reported by the government. The 10-year in response to all of this is down. You had the one-day trend. It started about 4.18, I believe. Yeah, 4.182. We are now sitting at 4.145, which is a meaningful change in the 10-year Treasury. It's come down a little bit, so you should see some temporary relief in mortgage rates. Not as big as we saw in previous meetings, but certainly temporary relief. Here's the VIX, the fear gauge. We're sitting at 15.66. You saw Matt comment on that during the stream. Started off at 17.5 down to 15.66. So there is less fear in the economy. I'm going to go ahead and switch to this camera here. And what I want to end the stream with is, number one, an apology. I owe you guys a little bit of an apology. Let me get back in focus for the rough start that we had to the stream today. OBS, I'm still kind of figuring out some of the bigger metrics. We want to do this stream strategically so that we start off next year knowing what we do and don't know. There's some challenges that relates to Mac and some of the studio equipment that I'm using here. We'll get that straight. Thanks for tuning in. I will have this posted to YouTube. Unfortunately, it will not make the other channels. We appreciate your support. Thank you so much. If you have any commentary, and for those of you who saw some of our other stuff, please feel free to let me know. And if nothing else, until next time, or if Said would say, if you were here, okay, bye!